Hello, everyone. Thank you for joining the 2017 investment forecast. My name is Sam Jones. I'm the Chief Investment Officer for All Season Financial Advisors, and this presentation falls under our Solutions Series live events. We run these quarterly, and the first quarter of every year is always investments and specifically an investment forecast. I have about 30 some odd slides to go through, so I'll spend a minute or so on each. And moving through, there will also be some meeting notes attached to this raw file if you receive. Hope to look at in this presentation are the market impact of the new administration, the aging bull market. We'll just sort of take the pulse of where things are, opportunities and threats that we see today, and then touch quickly on a project that we're working on called Exceptional Strategies. So first, the Trump factor, and I'm going to kind of filter this topic in throughout the discussion or throughout the presentation, but for this section specifically, we want to highlight some high-level issues that we're seeing just coming out of the Trump administration, and these are really themes. So the first theme that's maybe becoming obvious to everyone is that we may be in a new era of winners and losers. Winners and losers can be sectors, they can be segment population, they can be domestic versus international, but already, and really since elections, the market trends are becoming very clear in terms of which areas are going to be winning sectors and which areas are going to be losing sectors. In the end, when you have sort of equal numbers of both, the whole system can become a bit of a zero-sum game. Trump approaches everything, including campaign promises and discussions with the media and discussions with Congress, from a deal maker's perspective. That means you come in heavy and you ask for a lot and expect less. So we're already seeing that play out. Probably not atypical for every president who's run for our country, but Trump seems to be taking that to an extreme in terms of saying things like Mexico will pay for the wall, things like that pretty clearly won't happen, at least not in the traditional sense. Potential for high inflation, we'll discuss this a little bit later, and possibly leading to recession, not this year, but sometime between 2018 and rolling all the way into 2020. Much of what's coming out of the Trump administration and policies points to high inflation. High protectionism always leads to inflation. In the aggregate, we're not seeing a lot of net change to GDP or earnings per share, which is EPS. After all is said and done, again, back to the winners and losers concept. And just as an interesting historical note, tax cuts, if they come, or even as promised, are often seen near the start of bear markets and ultimately recessions, and I'll show you a little bit of evidence on that. I thought it was interesting to take a quick look at what the new tax rates look like. And these are several columns in here. On the left side, you see single filers, and on the right side, you see joint filers, just in terms of dollar amounts. But we're effectively going from 8 tax brackets down to 4 if this tax policy, tax reform proposals are put through and come through as indicated. Inside the red bars are some fairly dramatic drops in the effective rates. So for those making 50 as single filers or up to 100 as joint filers might see their tax rates drop from 25 to 12. That's a big change. And then similarly, for joint filers making $255,000 or less, their marginal would drop from 32 to 25. Also a very big jump. So you certainly could see some behavioral changes happening there. There's also a lot of discussion about the deductibility of interest as an expense. That would mean mortgage interest or debt interest at the corporate level. That would change behaviors and decisions that people make. And also a proposal to raise the standardized deduction up to almost $30,000 for joint filers. So for those who do itemized deductions, charitable giving, and things like that, you really won't be motivated or incented to continue doing that. You will instead choose to take the higher deductible standard deduction of $30,000, as most households don't incur that much in the way of itemized. Kind kind of back to this GDP point, there are bigger drivers in the economy than anything that's being discussed by the Trump administration. I just want to point that out. The baseline we're operating from in terms of a GDP rate is 2.6, that purple bar on the left. The variables on the bottom bar, the bottom axis, are really the most important things that drive economic activity. Oil prices, home sales, recovering wealth, restrained credit conditions, graying workforce, those are all bigger components of GDP than any president could ever invoke. So sort of this concept that one president and his policy could blow out earnings to 4 or 5% or whatever is being said, it has no precedent, and the market has already priced that in as a reality, as in GDP will not be running at 4 and 5%. Similarly, on the earnings per share side of things, if you look at some of Trump's policies do come into play here, specifically in the tax cuts. You can see that blue bar in the middle being a benefit to earnings per share. But again, like all things in this new era, a stronger dollar would actually take away earnings per share. There's also assumed to be no margin growth in terms of earnings from corporations looking forward because a lot of the policies are actually inflationary and cut into earnings, and I'll show you some examples of that in a minute. Another Trump factor that I mentioned before is the fact that tax acts or tax cuts by new presidents often coincide, excuse me, with new bear markets. There have been 4 notable tax acts since 1964, the first being from Kennedy. The second was from Reagan in his first term in 1981. The third was also from Reagan again in 1986. And then the fourth was by way of Bush in 2001. So if you scan across to the right and you see that yellow bar, you'll see the number of quarters until the next bear market started. The 2 most notable situations that are similar to today are the second row, as in when Reagan took office in 1981, and the 4th row when Bush took office as another new Republican administration. In both cases, bear markets started in the same quarter that the Tax Act was rolled out. So if we guess that that type of thing could or would happen looking forward, and we expect a tax act of some sort to show up, we wouldn't anticipate that until probably April or May. And in that same quarter, we're talking about second quarter of 2017, that could be the kickoff. Why does this happen? Hard to say, but certainly has a cyclical history of doing so. I mentioned that some of the policies could be tough on earnings. This is how that tends to show up. And I said smashing earnings with a bat, the bat being the border adjustment tax. But if you look at big companies where a lot of America spends their money, Walmart, Target, Home Depot, Lowe's, Samsung, consumer electronics, all the way through Whirlpool, you're talking about hundreds of thousands of containers that are imported into our country with goods made outside of our country. All of these goods would be taxed. Now, this doesn't even include food. And I've heard several interviews with farmers who are very concerned about import prices, etc. But they're effectively cutting into earnings by adding a tax. They may or may not be able to pass that on to the consumer. So that's just kind of one example, but certainly those types of policies might very well hurt the same people who voted for Trump. You've heard that quite a bit. Shifting gears to the length and the strength of this bull market. This is the second longest bull market in history, 2,836 days long. It is also in strength. It is about the third by the eye, 234% on the S&P. So it is not a new bull market. That's not new information. Conditions today are favorable, and I just want to sort of set that stage. That does not mean that the market has to buckle. Markets do not die of age. Bull markets do not die of age. However, we should note that after such a long time, the risks of a bear market do rise. It doesn't create a timing consideration necessarily. Just along those lines, economic conditions did turn up last summer pretty notably. They turned up in July after 7 consecutive down quarters. I think it should be noteworthy that all of this happened prior to elections. So while some might be taking credit for something called a Trump rally, the rally started in February of 2016. The economic cycle started in July of 2000, in November 2016. This rally that the stock market is in and the continuation of the economic expansion that has been in place since 2013 has been locked in for a long time. This is not a new thing. Any notion that the current president inherited a mess or anything like that is just talk, chatter. I would offer that Trump probably inherited one of the best economic conditions our country has ever seen. If you're looking at everything from employment rates on up. Confidence in CEOs sequentially are at 5-year highs, consumer confidence, home builders, small business optimism. This is not an environment that's a mess. This is a sparkling golden star of an economy. So just be clear on where we are, but things are still good and still healthy. Manufacturing and services are still heading higher. The 4-week average of unemployment claims is nearing a 43-year low. So once again, those same numbers were considered and called phony and fake under a different administration, and now they are a pleasure to see, according to the current administration. So we're just getting a lot of mixed information here. The Fed is certainly confirming the rising economy, as it has been for nearly 2 years, by raising rates. All things are good from a technical standpoint. No real cracks in the foundation yet. Again, I'm just sort of supplying fundamental and technical evidence. Leadership is good with the bellwether indexes. Advanced declines made a new high. Not everything is confirming, but I've seen much worse situations for sure. The risk side of things, I would consider this sort of an environment where we're tracking risk higher and higher. So think of like a hunter tracking and looking at prints. These would be prints in the snow as we, are tracking the bear, right? Like, where is it and can we find the prints? So certainly there are signs of higher risk market today that are clear and present. Rising US dollar and rising rates are pressuring earnings. Valuations are nearing extremes in both stocks and bonds. That's the first time in a while. Strangely, we do have a lot of similarities in this current market in terms of concentration of assets in a few company names like Facebook, Apple, Netflix, Google, the FANG stocks. That is eerily similar to 2000. We are seeing a little signs of selectivity and non-confirmation. That means things like utilities and transportation have not confirmed some of the more recent new highs. Sentiment is finally bullish, and I know that sounds odd, but for almost 6 years, investors have really held their nose at this market. They have held their money on the sidelines. They have not wanted to participate. There's sort of this sense of doubt or no confidence. And I've said in the last couple years, when everybody finally turns bullish, that's when we will start worrying. Well, that just happened. So bullishness is now very wide, almost at 67% bulls. And throughout much of the rising bull market of the last 7 years, bullishness was barely above 50. It was actually below 50 for much of it. So it's interesting that bullishness is finally showing up, and subsequently money shows up when people feel confident. These are tracks, these are hallmarks of the closing months and closing quarters of a multi-year bull market. So be aware that we're in that zone now where a lot of money is coming in, and that's worrisome. From a valuation standpoint, as I mentioned, this is a very long chart, all the way back to 1938 on the left-hand side through present. As Blaine Rollins with 361 Capital said just this month, valuation is itself a terrible timing tool, but it's equally important to understand that risk is heightened at the moments of high valuation. So here we are. In the last two peaks, the one to the left of current and the one before that, were the peaks in 2000 and 2008. So you can see, just for reference, that we're way up there. There's no doubt about that. I mentioned that there are some similarities in today's market to the year 2000. And if you look at a comparison of the Nasdaq 100, which is a very concentrated list of mega cap tech stocks, something in New York includes kind of the rest of the market, you see a wide divergence that has really manifested pretty dramatically since 2013. Now, there's a chance, I suppose, that the green line, the rest of the market, could catch up to the Nasdaq 100. But if history repeats, the companies in the Nasdaq 100 and the index itself would fall back to the value side of the market, which is the New York Stock Exchange. And I put a little iconic image in there saying air. There is a lot of air between these two indexes, and that's a bit worrisome. So again, timing is unknown, but recognize the risk, recognize where there's value and where there is an overbought market. In summary, I think the economy is still stable. Things are okay. It warrants a fairly fully invested position. Don't see signs of recession until 2018, probably associated with realizations of policies. I would call them maybe the failure of policy initiatives or failure of promises, or promises that are not quite what they were held out to be. Back-to-back bull markets like we saw in the 80s and 90s seems pretty unlikely given our valuations. Even the back-to-back event of 80s and 90s was interrupted by something that happened in October of 1987, and that was a 27% crash. So I'm not saying there's a crash coming. I am saying that we can't go sustainably higher without some sort of corrective event. And those events can be serious and definitely something we want to manage. Just from an upside downside measurement standpoint, I threw out kind of the extremes of earnings per share forecasts and looked at a bunch of them and came up with this as a bracket for upside. If there's no bear market, and this is 2017 numbers, right now the markets are at 4.8% up, believe it or not, in the first 15 days of the year. That's about a 50% annualized rate of return. So that's not going to happen. We can expect that something in the range of 0 to 9% seems realistic. Certainly the last years of bull markets can be fairly healthy, like 1999. But again, given where we are in valuations and not really having a big catalyst sector like internet or something else to carry us, it seems pretty unlikely that we would push way out. On the downside, just measuring various market metrics back to a 10 and 20-year average of these same numbers for the S&P, we would look at a market decline, S&P decline of somewhere between -13 on up, and on up means pretty devastating bear markets like -60. In reality, the markets tend to overshoot on the downside, and a very typical look from a valuation standpoint are the top two variables, price to earnings and price to book. So if we believe that the market might do twice either of those, we're talking about 26 to 30% decline. That seems very realistic to me when it happens. I'm not talking about immediately. I'm just measuring the downside. So skipping to opportunities. As started last year, the age of passive indexing, especially with something like a 60-40 portfolio of stocks and bonds and index funds, will and already is underperforming dynamic active styles of management. There are three variables that provide support and tailwinds for anybody who's running a more dynamic model, and they are rising rates, rising interest rates, rising US dollar, and a reversion to the mean. And that means that stocks tend to fall, and active managers who are trend followers, I guess folks like us, have the option, the flexibility, the willingness, and the capacity to cut exposure, get defensive, and wildly outperform a falling stock market. So those three variables, as they unfold, tend to point to dynamic active managed funds as outperformers for the next probably 3 to 5 years. I don't think that's wishful thinking on our end. It's already starting to show up. Fewer than 10% of managed funds, as in somebody with a manager, not an index fund, market in 16. That has now dramatically turned higher if I were to update this. And typically it happens on the back of a falling stock market, but certainly as the environment becomes more selective. Along those lines, we're certainly seeing rates rise from a very, very low level, a historically low level. Rates were lower, believe it or not, in the 50s. We saw a 2% long-term bond. But after that, from 1950 all the way to Reagan's inauguration in 1981, rates pushed all the way up to 14%. So if you're an odds player in here, you just kind of assume that rates are going to be moving higher. And that is, in fact, already happening. One of the key ways that managed investment strategies can outperform is by overweighting and underweighting sectors. So if you look at the weightings of sector performance relative to domestic and international exposure, if we believe that the US dollar is rising as a currency, we would generally want to be in domestic sectors that generally have most of their business done domestically. So that would be the light blue bar sectors: financials, consumer discretionary, utilities, real estate to a degree. If we believe that the dollar is going to fall and that international strength will take over, then we would predominantly want to be in the dark blue bars: technology, materials, industrials, and energy to a degree. So, you can really overweight and underweight a portfolio depending on what's happening in currencies and where the strength is in domestic versus internationals. We're doing that quite a bit now and have pretty healthy positions in financials, industrials, and materials. Strangely, we're on both sides at the moment. But we can really play sector strength and weakness in here to our advantage. Other opportunities are that Treasury bond money is going to be looking for a new home. And by that I mean that they will be, these would be investors who would be find bonds unattractive, Treasury bonds. They've been falling since July of last year, and we expect that trend to continue. We believe that a long-term bottom in interest rates has already happened, which means money is going to come out of the Treasury bond market. This is trillions of dollars, and this money becomes fuel for other income options. These could be corporate bonds, preferred securities, convertible securities, floating rate funds, variable rate notes, emerging market debt, pretty much anything that's still moving higher and paying 4 to 5% interest rates. Our retirement income and freeway high income strategies, this is where they live. They don't ever own treasuries. So these are considered unconstrained income strategies, and that's what we have been running for clients since 2003. For the first time in quite a while, stocks are outperforming bonds, so money's coming out of bonds. It isn't necessarily flopping over to stocks, although that is happening to some degree. But just back to the point, Treasury bonds, like a 10-year shown in green here, lost 2.95% over the last 12 months. The high income strategy that we run, which is probably considered unconstrained bonds by most, made 7.2 over the same time period. So we're not worried about this. This is actually a favorable environment for us. Other opportunities we're finding are in commodities. Last year, as of January, or looking back 12 months, Bespoke looked at all the prices of all the subsectors within commodities to see which were up and which were down. Just as simple as that. Then in the left-hand chart there you see that 22 out of 22 manufacturing sector input costs were up. 0 were down over the last 12 months. It's pretty dramatic. In terms of the price of the commodities themselves, we saw a lot of price appreciation last year, all the way across the board, from soft commodities to hard commodities. Corn, cattle, wheat, cocoa, those are still down, but now, strangely, they're resurging. So quite a bit of a performance opportunity there. Commodities are still very cheap on the long term. The cycle is right for it as inflation starting to show up. They're trading near 6-year lows. Tends to be a late cycle leadership group. And probably most importantly for asset allocators, commodities are non-correlated to U.S. stocks. If we find the stocks of commodity companies and commodities themselves, we have already started to build these positions in our high dividend and worldwide strategies. Shifting over to threats, as I mentioned several times, I do think Trump is a threat. And that's not a political statement. That's just sort of the consensus view that the policies and the lack of transparency and the shiftiness of the policies puts him somewhere between disruption and havoc. Havoc is like civil unrest. I don't anticipate that, but disruption would be on the low end of events. We're definitely looking at a tax policy and a reporting function and accounting that would have us actually view earnings in their actual form. I don't know if you're aware that companies have become masterful at something called financial engineering, which means massaging their earnings so that they look good all the time. Well, they have a lot of tools to do that, like depreciation and amortization and taxes and interest expenses. And if all of those are taken out of the tax code, it's going to be difficult for companies to massage their earnings. So in a good way, I like that. It makes earnings more pure. In a bad way, it's hard to get from here to there, where we go from sort of a manufactured earnings environment to real earnings, which are definitely not going to look that good, as in net income. Rising rates, rising inflation, we talked about that. Rising labor costs, these are all headwinds to earnings. Rising rates could also be a little tough on real estate. Not anticipating a big wipeout, anything like we saw before, but certainly a soft spot. And we're already starting to see that happen as rates have been rising now for almost a year and a half. The other biggest out there is probably the bursting of the sovereign debt bubble. This is foreign and domestic governments building enormous debt balloons in their coffers and issuing debt and quantitative easing. This is trillions of debt that really can't afford higher rates. So if the market chooses to push rates up and bond prices down, it's going to make life very difficult for a lot of governments to continue, and they very much do rely on debt spending. In March, we're coming right up on those very discussions in Congress to see if they do or don't want to increase our budget deficit and put push the ceiling up, in effect, which is just sort of amazing that this is still allowed, that our government is allowed to take a ceiling and just push the ceiling up. Just say, well, this is our high bar. Well, why even put a bar? Just raise it every year. But anyway, Trump isn't ashamed to say that he plans to do deficit spending on a massive scale, trillions of dollars. And that certainly will add to the debt pile and deficit spending. But the whole premise behind deficit spending is that you have cheap money, or you can print money, and that's all very inflationary and all very unaffordable if investors suddenly decide to sell their bonds. From a cycle standpoint, it's important to understand how volatility is a nice word for declines and big moves up and down, show up. And they show up first in currencies, and then they move to credit markets, which are like bond markets. And then they move to equity. That's the trend: currency, credit, equity. Since 2015, we've seen a much higher level of currency volatility. You can see that on the left-hand side. This year, and I would say starting middle of last year, we're starting to see Treasury bond volatility. That's starting to show up. Not in huge magnitude, but definitely seeing some spikes. What hasn't happened is equity volatility. We haven't really seen a big, strong down move beyond 2015. And several hiccups for sure in 2016 with Brexit and elections, but not real volatility. Real volatility is like waking up one morning and seeing the Dow down 1,000 points. That's volatility. We haven't seen that. So that's coming. Let's just anticipate it. It's just a question of when, not if. The final section, which I won't spend a lot of time on, is our exceptional strategies project. These are our goals. And it sounds silly to say be exceptional, but that's a relative term. And exceptional means you're different. It means you are the exception. And that portrays our view of the financial services industry, which is somewhere between poor and terrible in terms of its offering to investors. Our industry, advisors, brokers, and everybody in between, 9 out of 10 of them put risk squarely back on the shoulders of their investors. Every investor assumes risk when they put money in place. Very rarely is a brokerage house or an insurance company or anyone actually willing to carry the risk and be responsible for growing wealth and keeping it, capturing it. And so we find ourselves in an exceptional category trying to make that happen. It's not a foolproof process, but we've done it pretty successfully for quite a while, since the mid-90s. These are called asymmetric results, when you try to capture more on the upside than you lose on the downside. We are to improve those results by about 20% or more if we can. The time frame for that is almost 3 to 5 years, so it takes a while to have a policy or a set of rules turn into results on a monitored, measured basis. We're also trying to reduce all trading costs to less than 0.10%. Some strategies are already at zero. And we're also trying to improve the tax efficiency via generating long-term cap gains and monitoring our hold periods and trying to push out beyond that 12-month hold. So not an easy task, a very high bar in terms of goals, but we're plowing forward and working towards that end. Sean Powers has been hired full-time to do modeling and monitoring of our strategies, and he's definitely made us aware of our strengths and weaknesses. We know where we have work to do, and those are predominantly in our tactical equity strategies in terms of adding beta and adding higher upside capture ratios. We have strategies to do that, but we've chosen to affect those to be changing parameters after the next bear market. So effectively, we're going to turn the dial up on our tactical equity strategies, adding some volatility on purpose in order to generate bigger numbers on the upside during bull markets. But we certainly wouldn't want to do that just prior to a bear market. So we are certainly going to wait until that happens. And we could be talking about this year or next year or even the year after, but pretty strictly not going to do that right away. Along those lines, having the right mix of strategies with us, which is something we do in our review process, will become increasingly critical. So, for instance, if a client of ours had most of their money in our tactical equity models because they want to be sort of artificially aggressive for whatever reason, you will find that your portfolio volatility as a whole is going to go up after we make this change. If you're more balanced with all of our strategies, as we recommend, and follow our prescriptions, all you should see is an improvement in the upside gains of your portfolio without a dramatic change in the downside. So we're doing all the monitoring and measuring. We are looking at monthly upside capture ratios and downside capture ratios in each of our strategies, distribution of returns. We have some daily monitor that goes into tracking error and sector allocations. We're looking at all the different risk metrics of alphas and betas and making sure that our Sharpe ratios are positive. So we do this across multiple strategies. That's high dividend. This is all season. We measure it against our benchmarks, and then again, high income. So just know that we're focused on this as a project. The opportunity to be exceptional is very real to us, and I think the timing is also exceptional. So in 3 to 5 years, we hope to look back and say, job well done. That's all I have for today. Thank you for participating. These are many of the sources that we use for this presentation, much of which is speculative, our own work. But the clips and the graphics oftentimes come from other sources. We want to make sure to credit them. for their work, but generally the format and the themes here are all of our own. So I'll end with that, and please feel free to contact us if you have questions or concerns, or you want to look at doing additional business with our firm. Thank you.